right, well, welcome everyone to our interest rate seminar here at Bogart Wealth. Introduce myself. My name is Misty Garza. I am one of the financial advisors here for Bogart Wealth, and I am in the Houston office as well. So I hope everyone is staying warm. I know I think it's cold, whether you're in Virginia or you're in Texas. So we're going to take a little bit of time to introduce the firm for those of you that are not familiar with Bogart Wealth, and then we'll get into the topics here of interest rates and how they can impact your pension. Some of this is going to be geared towards those that are currently employed at ExxonMobil or retired and have their pension that they can make elections on, but it is going to pertain in general to interest rates in the market, where they're going, and potentially how that can still impact your pension if it is subject to the interest rates. This will be posted on our Bogart Wealth as well as LinkedIn and some of our social media sites. So if you wanted to be able to revisit this and look at those slides, you will be able to find that there in probably about 2 days or so. It will be posted. So let's get started. So a little bit about Bogart Wealth. If you guys are not familiar with us or are new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. A little background on us: we have about $2.6 billion in assets under management and a little over 1,200 households that we work with. We're a registered investment advisor, which means we're independent fiduciary advisor who works in your best interest. We do not collect any commissions off of anything that we might provide to our clients. We're a fee-only firm, and we custody all of our assets at Charles Schwab. Bogart Wealth does not maintain control of your assets in our name. If you have been working with us for some time, or if you visit our website recently, you can see that our team has been growing. We've had amazing growth this year with our team, and we have a really good team of advisors and all of the individuals who manage our assets and who work on the operations and planning side as well. So you'll see a list of some of the advisors here who work in our various offices. You know, one of the things that I like to point out is we have a really strong team. If you look at the individuals that are on this list, I mean, it's CFPs, it's people who have had lots of industry experience. And so what's nice about that is that through our experience that all of us bring to the table, some of us are experts in certain areas. You can't be an expert in everything because there's so many topics that we work with. But what's nice about it is of having such a broad breadth of individuals is that if one of us doesn't know the answer to something, there's probably somebody here on our team that we are able to actually go to and work with. And again, certain individuals have certain specialties. So it's really nice to be able to have a really good group of individuals who have a complete knowledge of the investment industry. This is our client service and financial planning team as well. Again, like I said, lots of new individuals, new faces that are on here that you might not have seen. Again, we work as a team. So when you work with us here as a financial advisor, you might have some correspondence back with our operations team, with our planning team. We really all work together as well, which makes it kind of nice to give us some really good support here with our team. More of our client service team, our financial planning team. We have a new marketing team as well here within our firm. So again, always continuing to grow here at Bogart Wealth. We manage all of our assets in-house as well up in our Virginia office. We have 3 locations for those of you that aren't familiar with our office. I am in the Houston office here on Gessner. Our corporate office is there in McLean, Virginia. And then we have our Woodlands, Texas office, which is very near to a lot of our ExxonMobil employees as well. For those of you who work with us, you know that planning is the heart of what we do. So most people think that planning for retirement is just about the investment management piece of it, but everyone's situation is different, and it's important to focus on your goals and manage the issues that are important to you, not just to all of the different areas of financial planning. And so if you're new to Bogart and you haven't gone through our planning process, I encourage you to reach out to your advisor that you're working with or to myself and talk specifically about what you and your family are working towards. For each individual, we start out with your plan based upon your goals, and depending on where you are at in that process, we work through that retirement analysis, work through your cash flow with looking at tax planning, tax optimization, whether it's now or in the future, depending on what stage you are currently in. And then, of course, the investment management piece of your assets, estate planning, very important as well. And then we review and monitor that. So this is a never-ending cycle that we work with our clients, because as you are working towards retirement or you are in retirement, you and your family will have different goals, tax laws will change, and it's important to make sure that your plan is something that is flexible and can change as the times change as well. We have a retirement readiness series that we used to do, a couple of years back, and when COVID happened, things changed a little bit. So we are putting together our series of various topics that we have. So if you would log on to any of our social media accounts, LinkedIn, Facebook, Instagram, all of those social media accounts, we will have posted our calendar of different retirement readiness seminars that we are doing as well. And so you would be able to join those live as well as go back and be able to view those as well too. So I'd encourage you to take a look at those various topics as well. So let's get started on how do the discount rates currently affect your lump sum. Some of this data, we're going to get super nerdy on some of this when we look at the way the interest rates affect your lump sum. We're going to go into some detail on specific rates there with the ExxonMobil plan, as well as just kind of the general market of where interest rates are. But then we'll talk in general as well as how that affects you as an individual. So first of all, one of the questions that might come up is which discount rate applies to you. So for almost everybody, you need to remember the general rule, and that is the rate that's in effect on your benefit commencement date will be the one that applies to you. So your benefit commencement date is always the first day of the month. Doesn't matter if the first day of the month is a holiday. For example, in order to get the second quarter discount rate, the absolute latest your benefit commencement date can be is June 1st. So by July 1st, we're already into the third quarter. Now, there's an exception to that, and I don't know if there's any grandfathered folks in the room or not, and we'll get back to the definition of grandfathered in a minute. But grandfathered in this situation means from the Pension Protection Act of 2006. And the main reason we mention this, and to have it in the back of your mind, is that there is a different option that applies to those grandfathered people. And so for those grandfathered individuals, they have the option to choose the first available benefit commencement date that they can on their first day of retirement, or the interest rates that are effective on that benefit commencement date. So what that means to an individual, to put it in terms of an example, is that they would make their last day of employment on June 29th. So their first day of retirement would be June 30th. So now they would be able to either choose the second or the third quarter interest rates. So that applies to a very few people. And we'll talk about kind of what those age requirements are and who those people might be, but we typically don't find too many individuals that are on the grandfather. So the general rule is the one that we'll spend most of our time talking about today. So, okay, so I mentioned the Pension Protection Act of 2006, which actually took effect in 2007. And so the most important part of this is that it places limits on companies who provide lump sums. So for instance, a pension must be 80% funded in order to be able to offer the 100% lump sum option. So I know that some people are concerned about whether or not their pension is fully funded. So this helps provide guidelines on making sure that that lump sum option is there to stay. And so if their funding levels were to drop, then your lump sum options can change. It's never happened to ExxonMobil, so we don't worry about it too much. Now, some of the individuals, we've seen a few of the options change of the 2575. That does not pertain to anything to do with this Pension Protection Act. That is just a matter of administration of the plan. What are some of the most favorable options that people end up choosing there? So this also defines the discount rates that we'll use, and we'll talk about that in specific detail on how those interest rates come into play. And it also defines the actuarial tables that are used. So now companies are required to update their table at least once every 10 years. So the last time this table was updated was 2018. Just because a new table comes out, as they come out every year, does not mean that the company has to use it. They must update it within those 10 years. So since Exxon updated their table in 2018, they actually have until 2028 to update the current table that is in force. So there's a few other changes that were pertinent to this act, but they're not relevant to today's discussion. So let's move on. So, okay, so the definition of grandfathered really quickly. So you remember that I said the Pension Protection Act of 2006 took effect in 2007, and companies had 5 years to fully implement the new provisions of this plan, whether they phased it in or they did it in one fell swoop. So Exxon decided to do it in one fell swoop. So by the end of 2012, you had to have been 55 and have 15 years of service to be in this grandfathered category. So what this means is that you had to be born before 1958 and hired before 1998 with no breaks in service. So right now at this time, you would already have to be 66 years old and have 26 years of continuous service. So again, when you think about who is currently there within Exxon, very few people still in this category. So there's not many people left. So again, for these individuals, the calculation is pretty simple. You just use the 30-year Treasury bond, and we'll kind of go into a little bit of details there. And also they get to use the 2000 mortality tables. So no changes to those tables for them. So a couple more slides on grandfathered, and then we'll get to the non-grandfathered individuals. So this chart shows the 40 plus years of the 30-year Treasury bond. And so everyone knows that we just came out of historic lows. People think they're going back to normal or maybe higher, but they're not going back to the 80s. You can see that trend in the chart there. So it's despite the fact that we've had high inflation, which is actually coming down. So yes, we recognize that it is higher than what we had seen the trend, but definitely not going back to where it used to be. So for the current grandfathered individuals, the current discount rate for those, we take the weighted average of every day, because every day counts for this group. And then we take 95% of that and we round it to the nearest 0.25% of those 30-year treasuries. So again, remember, for those individuals who are retiring, rates are calculated looking back 2 quarters from your benefit commencement date, okay? So that's all we're going to talk about here for the grandfather, because again, very few people that this applies to. So if you are in this group, just know that we can talk more specifically about what this means for you and how those rates are a little bit different. So please don't hesitate to reach out to us. So, okay, so moving on. For those that were under 50 and had 10 years or less of service on December 31st, 2007, these new rules apply to you. So the new rules are based upon corporate bonds instead of government bonds. Now, what this means to you as an individual is typically corporate bonds, or the rates are a little bit higher than government bonds because they're a little riskier. So the rates are based upon 3 points along the yield curve. And if you want to track them, they're published by the IRS, and you can see their address here on the website if you really wanted to go in and look at those as well on a daily basis. So the IRS posts what those are, so we know what those numbers are going to be before the Treasury posts those, so we can get a feel for what those interest rates are doing there. Now, remember I said that they're segmented into 3 different pieces. Okay. And they also use the IRS mortality table that's updated every 10 years. So the idea when they extend those tables and living a longer life is good because it means that you need cash flow over a longer period of time. So it kind of give you a little bit of perspective. This is what rates have looked like ever since the IRS has been publishing them. So they only go back to 2013. And again, we're looking at 3 different segments. So segment 1, which is the green line here, is shorter term rates. So shorter term rates are 6 months to 5 years. Segment 2, which is the blue line, is 5.5 years to 20 years. And segment 3 are the longer term rates at 20.5 years to 60 years. So as you can see, shorter term rates are more volatile than when compared to the other 2 rates. When rates go up very quickly, as we've seen over the last year or so, these get very compressed, okay? So remember, only the last 2 months in the quarter are used in the calculation for the interest rates. So we track the daily rates for each segment and then compare that to the market data that's published by Bank of America and the IRS to get a prediction, okay? So we get a prediction of, since the first month does not count of that quarter, it can give us an indication of where rates are going if we think that they are moving in an upward or downward trend as well. So we already have the first and second quarter rates, as you can see here, because remember, it's looking back 2 quarters. So for first quarter rates of 2024, we're looking at the August and September rates of 2023. Second quarter of 2024 benefit commencement date is looking at November and December. So currently, right now, the first quarter that we are in, this is going to impact those that are looking for a benefit commencement date of the third quarter. Now, again, remember, keep in mind, January does not count towards that. But again, it does give us an indication of whether or not rates are going up or going down and helps us make some predictions on where interest rates are moving. So here's some data in a little bit of a different format. Sometimes it's hard to look at the numbers and decide how big of an impact do those rate decreases or increases have on me. So what we do is we back calculate what we call the single equivalent rate. And so for those in the non-grandfathered category, it's very easy to see the overall impact when short-term rates are moving at different speeds or even different directions. So to address this, we estimate this single rate that makes comparison a little bit easier. I'm going to explain all of that in the next few slides. And then once we have this single equivalent rate, we can compare one quarter to the next of whether or not electing a benefit commencement date in the first, second, third, or fourth quarter is more advantageous to you. Now, again, it also can be different for people who are 60 versus people who are 55, and we'll get into that a little bit as well, too. So again, a little bit of history on where the corporate bond rates have been. I showed you the history of where the treasuries were. So again, remember, corporate bond rates are typically a little bit higher because the risk factor is a little bit higher on these. But again, the trend line looks very similar to what the treasuries were as well. So again, they only go back to 2013 as far as they've been tracking these, but we use the same method to kind of backdate this to look to see where the trends were going back a little bit further. So we have this casted all the way back to 1984. So a couple of points here. As you can see, rates have moved up quite a bit from their lows, and they were at the bottom around the pandemic time. But before the pandemic, rates were the lowest it had ever been in history. There were a few times as people were retiring and they were thinking, oh, this is the lowest the rates have ever been. They can't go any lower. And then you start to see, again, the trend line continues to move down. So we've clearly increased since 2022. They look to be higher than the average that we've had in the past decade. We don't really know for sure what's caused that downward trend over the last several decades. So we don't really know where we're going to end up and if we're going to create any additional, new highs or new lows either. So Now that we've addressed the interest rates, the question now is, how do these specific interest rates and their movement affect your lump sum? So the next few slides are going to tell you a little bit about that and how we calculate that. So what we're showing here is a very simplified example that clearly shows the impact of age at retirement, life expectancy, and the interest rates. So this does not get you to the exact amount of the lump sum, but it does get you within about 10% or $10,000 for every $1 million as we're calculating this. So the current mortality tables have a 60-year-old living until 84. So in this example, we have an annuity for someone that's paying out $76,000 a year. So we've contrived the scenarios so we can make that lump sum $1 million for easy math purposes to be able to see the impact of that. So what we do is we put in the interest rates for each of those 3 segments. So you can see, remember the first segment is for the first 5.5 years, and then we have the second segment, and then the third segment comes into play as well. So now that we have these interest rates in here, we can calculate what we consider the discount factor, that single equivalent rate that we're looking for. And so the discount factor is, how much do I have to invest today to create this future cash flow? And we call that the IRR, the internal rate of return. And so in this scenario, we have calculated that to be 5.56, okay? Now, this is what happens if somebody is younger. The previous example was somebody at age 60. If somebody is 55, they're a little bit younger. So we have the same discount rates. Their annuity is reduced because they're choosing to take it 5 years early. Now, life expectancy is a little bit less, 83. But what you're going to see here is that if you leave at 55 instead of 60, you get that haircut that we talked about on the annuity basis only. On the lump sum, you're getting a smaller annuity for more years, so the haircut doesn't actually come out to be 25%. Retiring early and electing the lump sum pension, it's not an insignificant amount, but it's much less than a lot of individuals who look at that of just saying it's a 5% haircut every year. Usually equates to about 3%. So now you'll notice that a person who's retiring at 55, they're going to have more years in segment 3. So when we talk about the age of somebody retiring and what the value of their lump sum is, the sensitivity of the different segments, those 3 different segments, will have a bigger impact on the younger retirees because they're going to be in those segment 2 and 3 much longer. So this is just a simplified example. It doesn't give you the exact numbers that the pension planner is going to give you, but very helpful in kind of cementing in your mind what the impact of the different rates are. So I'm going to shift gears a little bit and talk about how you can calculate the single equivalent rate. And there's 2 methods to doing this. For those of you who like the Excel spreadsheet, you can calculate what that discount rate is, the IRR in Excel, where you just put in the lump sum as $1 million as a negative value. It's negative value because you're buying the annuity, and then every year you're going to get the $76,000. So in that cell, you're going to put in IRR for whatever this range is, the minus 1 million up to the last year of the annuity payout, and then you will do the goal seek method as listed here. Again, a little more involved, but you should get to some of the same answer. So, okay, so the real question really is now, how big of an impact do the interest rate changes have on your lump sum? So now that we know how to calculate what that single equivalent rate is, or what that internal rate of return is, that's what we will use to compare it. So let's assume someone is age 60 and they're retiring in this first quarter, okay? So the single equivalent rate is 5.56. This gives them a lump sum value of about $1 million. So when we work out how much the lump sum changes as you increase interest rates, we only went up to 2%. And so we can see what 1%, a 0.5% increase will change in that lump sum value. So a 1% change in interest rates, an increase in interest rates, will affect your lump sum by reducing it close to 9% as well. A 0.5% change, roughly about a 5% reduction in your lump sum. So it's not linear, but you can see here that our rule of thumb is basically for every 1% change in interest rates, it's about a 10% change in your lump sum. Okay, that goes the same for decreasing interest rates as well, and what those percentage changes are. So this slide is the same that we showed at the $1 million lump sum, but we lowered the interest rates. And so as we lower those interest rates, you can see the impact of what that does. So this previously had a little bit of a higher interest rates. We changed segment 1 to 5.26 from 5.52. Segment 2, we reduced it to 5.45. And segment 3, we reduced it just slightly to 5.49. And so remember, this was going to give you $1 million lump sum. So with this reduction in interest rates, it actually bumped it up to just over $1 million, to $1,011,000 as well. So that's the little bit of the impact of knowing what those single equivalent rates are and what the segments are, how old you are, and how that could impact what that overall lump sum number is. So one of the things to think about is, with interest rates higher than potentially where they've been, is when would one consider delaying taking the pension given the current environment? And so one misconception is that people think that when they retire, they have to elect their pension. And that's just simply not true. You can choose to delay your qualified portion of the pension. Now, everybody's situation is different, and depending on whether or not you're taking the lump sum or the annuity or a combination of both, you should really visit with your advisor to determine the pros and cons of each option. Now, if you are taking a combination of the annuity and the lump sum, you cannot choose to just take the annuity portion and elect the lump sum later. So those do have to work in conjunction together. So given the current interest rate environment, again, working with an advisor to determine where you are, what your age is, and does it make sense in the timing of electing that pension. So if you don't need the money right now and you're retiring before 60 or expecting interest rates to fall, you might want to talk through your decision with your advisor to make sure it makes the most sense. All right, so now let's talk a little bit about timing and preparing for retirement with decisions that need to be made. So again, we already talked about the fact that when you do retire, you do not have to elect the qualified portion of your pension. So we have a few different ways to show this. We have this really nice, pretty picture illustration here, and then we have a little bit more of a technical with some dates. So I'm going to go with this version because it gives people an idea with specific dates in mind of when you would need to make some decisions there with your employer. So if you're looking to retire or retire with a benefit commencement date potentially of June 1st, 2024. So remember, when I'm thinking benefit commencement date, that does not necessarily mean that you are electing the pension. It just means that you potentially had a retirement sometime prior to that, maybe a May 31st. So June 1st becomes that commencement date for other benefits as well. So the first thing to do is 90 to 120 days out, you'll inform your supervisor, your timekeeper of your last day on the payroll, and then you request your intent to retire package. So for some individuals, this can be done online, and for others, you can contact the pension group directly. Now, I know there's been lots of changes with the benefits group as well, too, so I know that they're working through some of those new contacts in order to make those pension elections. So the pension package must be turned in good order 35 days prior to your benefit commencement date in order to receive your payment on that date. So if you have a benefit commencement date of June 1st where you are electing the pension, whether it is the lump sum or the monthly annuity, then we are looking at potentially getting it in this May 30th timeframe so that they have plenty of time to get that done. Here within this February 23rd timeframe to get that done 35 days prior. Now, If you miss that, it doesn't mean that you've missed the opportunity to make that your benefit commencement date. It just means the payment is not going to arrive on that June 1st date. So what it means, it'll just get pushed out. They only do those elections on the 1st of the month. So that will be on the next available 1st of the month in order to receive those. Now, you also need to get your medical benefit payments set up on the benefits website. So no matter what your pension election is, if you're choosing to defer the pension or you are making an election, you still want to enter in all of your medical benefit elections with your payment methods so that your healthcare premiums can continue to be paid. Now, keep in mind, one of the things to think about is you are going to get a new medical ID card. You're going to be moving over to the retirees portion of the ExxonMobil medical plan. So we typically will encourage people that if you retire and the very next week you have some doctor's appointments, you probably don't have your new card. So keep that in mind as you might be kind of going into that retirement phase. And if you did have some medical appointments, need a little bit of a grace period to get that new medical card. So the rest of this is in regards to your VOIA savings plan. Now, when you retire, you do not have to make a decision on your 401k. So I recommend that you talk to us, you talk to your advisor, you educate yourself on what your options are within the VOIA savings plan once you retire. There are different things that you can and cannot do within your savings plan. So it's important to make sure that you have that plan in place to continue your cash flow. So some things to think of now. If you don't have a retirement plan, get a retirement plan. If you don't have one, we would love to help you create one that's specifically for you and help guide you through this decision-making process. It's also really important to create a budget. You want to know what your cash flow goals are before you retire. And a lot of that is going to help determine when and how you take the pension. What do you do with your VOIA savings plan as well? So very important to know what those needs are. If you have always lived off of a budget and you know what those expenses are, one of the things that we talk with people about is looking at what your current expenses are and how many of those are going to filter over into retirement, what things are going to go away, what things are going to be added. So we've worked, with so many retirees. We've been through this thousands of times. And so sometimes we can help guide people if they're not really sure how to create that budget or what that budget's going to look like or what they're going to need. Because we've seen this so many times, it's very easy for us to look at something and say, you're missing a few things, or what do you think about this? Or again, if you're not really sure, we can help give you some questions to kind of think about how does your budget maybe look a little bit differently in retirement as well. So it's very important to also then understand what your long-term risk profile is. And so a lot of that has to do with what your plan says and what the numbers say you need in order to be successful. But there's also two other components to that. The financial analysis can tell you that you need, X% rate of return in order to be successful to achieve your goals. But you personally might not be comfortable with that goal. Maybe you want to be a little bit more aggressive because you want to leave, you want to build wealth and leave that behind to your family. Or maybe given the current status of the stock market, you just might not want to be as aggressive as you had been while you were accumulating. So it's very important for us to work with you to figure out not only what do the numbers say that you need to achieve to be successful, what are you comfortable with achieving as well? And how does that figure into your overall success of your plan? So one of the questions that I always get asked is, how do you select an advisor? What are some things to look for with an advisor? And so I think it's very important to find an advisor that's very much in line, that's somebody that you feel comfortable with, and that also is qualified, that has done this and has been through this many times. So in today's environment, having a certified financial planner, I believe, is very important. It is not just about creating an investment portfolio. There are lots of things we showed how we create our plan of estate planning and tax optimization and cash flow. It's very important to understand how the pension elections play into that and how your VOIA savings plan plays into all of that. And what does the future look like when required minimum distributions start? It's not just about investing your money today. So having a planner who focuses on all areas of financial planning, I believe, is very important. You want somebody who, again, has created a plan, and we know what your plan is, and make adjustments along the way. Also knowing IRS rules as they change every year. We have the Secure Act that started, and those changes are going to slowly be phasing in over the next couple of years. And so not only are we looking at where the IRS rules are today and tax laws are, we're also looking at what are they next year and how does that play into your specific plan as well. And you want to also find a firm who's navigated, multiple business cycles. The market is ever changing, and we want to be able to have somebody who has that experience of going through those different cycles, the business cycles, as well as your own personal cycles of life as well. It's very different from an accumulation phase of when you're working to more of a distribution phase of when you're retired, and then more of a family wealth distribution. As you've accumulated that wealth, how do we distribute that as well to our beneficiaries? And manages portfolios. Some financial advisors will manage portfolios in-house, and some advisors will seek outside sources. We manage everything in-house here so that we can have that one-on-one relationship on knowing exactly what's most beneficial to you and how to put your investments in certain portfolios to achieve your goals. So, you also want to look at an advisor who discusses various strategies with you. There is not a one solution fits all for everybody. Everybody's situation is different. There are multiple options. So finding someone who can explain those options, speak with you in a way that you can understand. I have clients who are sometimes very detail oriented. And so our conversations can be very different to somebody who just really wants more of a high level, right? They say, this is why I have you guys. I don't want to know all the details. I don't want to be involved with that. I want to enjoy my retirement. So really the goal of that advisor is finding somebody who captures whatever it is that you're looking for during that relationship. So one of the things that we offer here at Bogart Wealth is we will offer a one-on-one financial strategy session, complimentary. We find it very important to find out, where are you at in your accumulation, in your retirement phase, and figure out, can we help you? Do you want our help? And look at where there are some opportunities to better your situation, or what kind of advice and guidance are you wanting from us? So again, we focus on that plan. We offer that strategy session complimentary, no matter what stage of life that you are in. Again, a little bit of some contact options here for us at Bogart. If you would like to have a one-on-one personal discussion on what you're working with, you can contact us toll free here. You can go to bogartwealth.com and find all this information on our page. So you're welcome to contact us toll free, and they can route you to whichever office is most convenient. Or if you're welcome to go to our webpage, and you have a list of all of the advisors and the individuals who work here at the firm. Then you can read a little bit about what each of us bring to the table, what our backgrounds are, and if you find somebody that you feel you would be comfortable with to pursue that, again, please feel free to reach out to those individuals as well. And so I would like to thank everybody for joining this seminar. If there are any questions,